All right, let's talk about a huge question. How does money actually move through our economy? It seems really complex, right? But I promise, by the end of this, you're going to have a much clearer picture of how the whole financial system works. So let's jump right in.
So, think about this for a second. You put some money into a savings account. You assume it's safe, it's just sitting there. But it doesn't just sit in some vault with your name on it. That dollar you deposited, it's about to go on a pretty wild journey. And we're going to follow it.
You see, at its absolute core, the financial system is really about one simple thing. It connects people who have extra money with people who need money. You can think of it like a giant, super high-stakes matchmaking service for cash. And when this system works well, that flow of money is what fuels growth across the entire economy. So you've got two main players in this game. On one side, you have the suppliers of capital. Hey, that could be you putting money aside in your savings, or it could be a massive pension fund. The point is, you have excess funds and you're hoping to get some kind of return on it. And on the other side, you have the demanders of capital. This could be anyone from a student needing a loan for college to a startup trying to build the next big thing, or a huge corporation that needs to build a new factory. They need the cash and they're willing to pay for the privilege of using it.
Okay, so that's the million-dollar question, isn't it? They don't just bump into each other on the street. They need a place, a venue, where these kinds of transactions can happen safely and efficiently.
And that's where financial markets come in. This is the next major stop on our dollar's journey. This is the arena where those savers and borrowers, the suppliers and demanders, are actually brought together.
So the textbook definition is pretty straightforward. It's just a place that brings together folks who want to borrow money with those who have a surplus of it. But market is a huge term, right? It covers a lot of ground. So let's break down the different types.
First off, you can split markets into physical assets versus financial assets. Physical assets are things you can actually touch, real estate, cars, machinery. Financial assets, which are what we're going to focus on, are different. They're not tangible things. They're claims on some company's future income. Think stocks and bonds.
We can also slice it by time. You've got money markets, which are for short-term stuff. We're talking debt that's for less than a year. Then you have capital markets. That's for the long haul. This is where you find things like long-term debt and, of course, stocks.
Okay, and this next one is really important, so listen up. You have primary markets and secondary markets. The primary market is where a security is born. It's when a company sells its stock for the very first time to raise cash. The secondary market is where that stock lives out the rest of its life, just being traded back and forth between different investors. The company itself isn't involved in those trades. Seriously, remember this difference. It's absolutely key. Now, of course, this whole process doesn't just happen by magic. It needs guides, experts who help everyone navigate the system. And these are the financial institutions. And there's a whole cast of characters here. These are the intermediaries, the matchmakers we were talking about. You've got investment banks that help companies sell that new stock. You have commercial banks that take your deposits and give out loans. And things like mutual funds or ETFs, they pool money from lots of different savers and invest it for them. They all play a vital role in making sure that capital flows from the people who have it to the people who need it. So now let's zoom in on the most famous financial market of them all, the stock market. This is where those ideas we just covered, especially primary and secondary markets, really come to life in a big way. For any company, the gateway to the public stock market is the initial public offering, or IPO. This is a massive primary market event. A private company decides to go public, selling shares for the very first time to raise a ton of capital from all sorts of investors to fund its future growth. All right, pop quiz time. Let's make this super concrete. Let's say Apple decides it wants to raise some money, so it creates and sells brand new shares of stock. An investor comes along and buys some. So is that a primary or a secondary market transaction? Ding, ding, ding. That is a primary market transaction. Why? Because new shares were literally created out of thin air, and the money from selling them went directly to Apple. Okay, round two. What about this? You pull out your phone, open up your brokerage app, and buy 10 shares of Apple. You're not buying them from Apple directly, right? You're buying them from some other investor out there who decided it was time to sell. Primary or secondary? Yep, that's a secondary market transaction. This is what's happening millions of times a day. No new cash went to Apple from that trade. It was just a swap of existing shares between two investors. In fact, almost all the stock market activity you hear about on the news every day, that's happening in the secondary market. And if you want to see what all that secondary market trading adds up to over the years, well, take a look at this. This chart shows the returns of the S&P 500.
Each one of those bars represents the outcome of millions upon millions of investors just buying and selling existing stocks from each other over decades. And if we zoom all the way in from the long-term view to this exact moment, this is what it looks like. A stock quote is basically a real-time snapshot of the secondary market for just one company. You see the price, the volume, it's the pulse of the market, and it's driven entirely by trades between investors. So we've mapped out this massive, complex system for moving money. But this leads to the real billion-dollar question. With all this information flying around, all these experts, all this technology, are the prices we see actually the right prices? I mean, how efficient is this whole machine? This brings us to a huge idea in finance: stock market efficiency. The core theory is pretty simple. It says that all the available information about a company is already baked into its stock price. And because this happens so incredibly fast, securities are almost always fairly priced, which makes it really, really hard to consistently beat the market. So let's test this idea. Imagine you see a news alert. A drug company just got a huge new product approved by the FDA. You think, aha, this is my chance. I'm going to buy the stock before it shoots up. Can you actually profit from that information? Well, if the market is truly efficient, the answer is no. Sorry, it's already too late. By the time you read that headline, thousands of professional traders and their algorithms already saw it and acted on it. The price adjusted pretty much instantly. The opportunity vanished. Okay, what about another classic scenario? You hear about a hot IPO. Everyone's talking about it, saying it's the next big thing. Should you plan on scooping up as many shares as you can the very moment it starts trading? The practical answer is probably not. See, it's incredibly rare for a small individual investor to get that initial pre-trading price. And frankly, the long-term performance of a lot of these super hyped hot IPOs, well, the track record isn't always so great. But here's the big twist. The whole efficient market idea kind of assumes that we're all perfectly rational robots. And there's a fascinating field called behavioral finance that points out, well, we're not. We humans have cognitive biases. We anchor onto our beliefs and ignore new information. We feel risk differently when the market is up versus when it's crashing. We make systematic, irrational mistakes over and over again. And that leaves us with a pretty fascinating final thought, doesn't it? We've built this incredible global system that's supposed to run on rational data. So if the market is built on logic, why are we, the humans, actually using it so predictably irrational with our own money? Now that is something to think about.